It's sort of a Tony Soprano world where any business can get shaken down. And so the regulatory environment of the United States began to kind of look like a sort of mafia kind of justice where anybody and almost everybody that was trying to do anything was in the crosshairs. We're facing an entirely different situation now where the regulators are beginning to look at real risk and aren't just looking at risk processes. And so we're moving from an environment of risk theater to actually risk oversight. There is a question of how many regulators do we need to do that? That fear-based mentality has never served this country well. And I'm not saying that there aren't going to be mistakes made or problems. Any new technology, any new business model is going to have some degree of failure. But that's what the United States is best at. Look, we have a saying, you can be doing things right or you can do the right things. And there's nothing wrong with doing things right. But if you're so busy doing things right that you don't do the right things, you're going to get a Silicon Valley Bank. You're going to get a Countrywide where the boxes were checked and the Titanic went down.
So one could argue that the American regulatory landscape for banking right now is in a state of, let's say, limbo. We had Silicon Valley Bank, that failure really highlighted some blind spots in supervision. We've had more and more details being revealed about Operation Choke Point, where you have, agencies, rather than trying to figure out how to manage new innovations, we've decided to sort of stamp out and avoid them altogether. Now we have this arrival of a new administration that's talked about trimming down or consolidating agencies like the FDIC, the OCC. They've talked about abolishing the CFPB. And just the other week, we've had FDIC Vice Chair Travis Hill, who's talking now about an entirely new approach to regulating banks. And, Hill is the guy who is going to step into the acting chair role, and he's one of the top contenders for the agency itself, right? And he's out there talking about, the need for a cultural reset for the agency. All of this is on top of the fact that, we have a U.S. that has perhaps one of the most dynamic and decentralized banking systems in the developed world. Thousands of banks across the country with overlapping sort of oversight at both state and federal level, right? So there's a lot going on. How do you expect things to move forward, or maybe better yet, how do you think things should move forward, right? What's the opportunity here?
Well, the opportunity here is for the U.S. to move into a leadership position, because there's an industry where it had been treated by the current administration as kind of like the boogeyman, and a whole bunch of scare tactics were used, basically regulation through enforcement actions, suing people not that were committing fraud, but suing people and just saying, you're not doing things right. That we're going to look at your processes and we're going to sue you. We're not going to come in and have a chat about, we'd like you to do it this way or that way. Just there were scores of lawsuits. And the key thing was not actually promulgating new rules. So at least people could say, okay, well, now you've told us how to do it the right way. They're just suing everyone, saying you're doing something wrong. And in that environment, everybody just keeps their head down, and very hard for innovation to happen when everybody's scared. It's sort of a Tony Soprano world where any business can get shaken down. And so the regulatory environment of the United States began to kind of look like a sort of mafia kind of justice where anybody and almost everybody that was trying to do anything was in the crosshairs. We're facing an entirely different situation now where the regulators are beginning to look at real risk and aren't just looking at risk processes. And one of the things we learned at Silicon Valley Bank, which was an example where, because all the risk processes were being done the right way, regulators didn't spend much time actually looking at the real risk. And so we're moving from an environment of risk theater to actually risk oversight. There is a question of how many regulators do we need to do that? Do we need all the regulatory organizations that we have? Only the United States has this layered web of overlapping regulators. And there's sort of a saying that just because you have more men around doesn't mean you can have a baby in less than 9 months. So having extra regulators around doesn't necessarily mean that regulation is being done better. Do it once, do it right. Don't let people pay regulatory arbitrage by switching to a regulator that may be less sophisticated and less attuned to what the actual real risks are. And so all that is on the table. So we are entering a new era. And what it could mean for the United States is we move from an also-ran or a laggard in this industry to being a leader.
If you're a business, if you're an entrepreneur in this space, all of that sounds great, right? I think maybe, playing devil's advocate, the primary concern is if we sort of go the other way, right? Because ultimately the FDIC, the OCC, these agencies are playing an important role, right? And so what would actual smart regulations look like versus just this pure deregulatory approach?
In my opinion, smart regulation would be layered, and it would start with the regulators focusing on real risk. They don't have to ignore processes. They can have a checklist, but instead of just coming in with a checklist, they need to sit down and have a conversation. This is a two-way conversation, and talk about what the real challenges are for the business that could cause either a collapse of a financial institution or consumer harm. And of course, they have to do all the analysis to see whether there's fraud. Nobody is debating whether there shouldn't be reviews of whether fraudulent activities are going on. But in terms of actually understanding whether there's an activity that's going on that could cause the financial collapse of an institution, that should start with a conversation. The first thing that happens shouldn't be getting a letter being told that you're going to be sued, right? That's the last thing that happens after attempts have been taken by both parties to get on the same page. The other thing is, if somebody's doing something that has more risk, a regulator can say, we're uncomfortable with the level of risk. We may disagree on what we think that level of risk is, but we're going to actually advocate for higher capital levels, not insane capital levels that make it impossible to even do the business. But if there's a belief that something, and there's not data to show that it's not risky, you can simply ask for a higher capital level for that activity. And so those should be conversations. And only when those conversations fail should there be written guidance given, essentially some type of consent decree. And then the last weapon is to actually sue, to actually come in and have an enforcement action and take someone to court. In the recent regulatory regime, we often had situations, especially with the SEC, where they started with the hammer. They started with simply a Wells notice, and then a big rock was going to fall on your head. And everybody's afraid of that. Nobody wants to be spending all their time waking up being sued. And so people keep their head down as opposed to keep their heads up. And it starts with a conversation. And many of the interactions between regulators and the parties they regulate are very formal, stiff, scripted. That's not how risk management works. I mean, that's not how you ski down a steep mountain, right? You are engaged with the risk at hand. It's directly in front of you. And, if you have a coach, they're out there, talking with you. It isn't like you get your annual report. This is how badly you skied. You should do this, this, and this. That's not the way coaching should be. And so to some extent, good regulation should be like good coaching, including taking feedback from the athlete that's being coached. And there is a prospect, and some of the signals coming from the new guard coming in with some of the regulatory agencies is recognizing that fact. And there's going to be a move away from regulation by enforcement actions.
So part of it is better engagement with the industry, right? Part of it, to your point, is actually managing risk rather than avoiding it altogether. What about some of these newer, I guess, developments? Let's say maybe in fintech, where money is moving onto these other platforms, or now we have instruments like stable coins. How should we be looking at this sort of new era of digital money products?
Well, we have an existing set of banking rails in this country. They're not going away. And the question is, can they coexist right next to blockchain-based ledgers that operate 24 hours a day, 7 days a week? I think they can. I mean, our view of the world is the ideal forms of money have an address and are accessible in the world of crypto, including DeFi and CeFi, but they also ought to be able to interact with the traditional world. So I don't see why you need a different account to basically receive your your paycheck comes into an account, and you ought to be able to, from that account, do things that you do on the blockchain. You ought to be able to send it 24/7 to any other person who has an identity on the blockchain. And you ought to be able to do that regardless of where they live in the world, what industry they're in. You can still have regulations saying there has to be compliant identity, so you know that they're not somebody who's on the OFAC list. But if someone isn't doing something that's illegal, unlicensed, somebody's on the OFAC sanction list, then why wouldn't money move around as easily as we move text messages, videos, music? It's basically saying that the world of money should work as easily as anything else on the internet. And when the internet came along and the World Wide Web came along, we didn't have an end to radio and television and magazines and newspapers, but all that content became interoperable with the internet as well. And that's what we're looking for money. And the US has the most trusted financial system in the world in terms of the legacy system. But the concept that you would isolate that from the innovation, which is pretty much the mindset of the last administration, is we have to basically segregate this new innovative world from the legacy world, or else, oh my gosh, it's going to be Noah's Ark and 40 days of rain and the world's coming to an end. That fear-based mentality has never served this country well. And I'm not saying that there aren't going to be mistakes made or problems. Any new technology, any new business model is going to have some degree of failure, but that's what the United States is best at. And so I'm glad to see that we're not going to take a fear-driven approach, which is how China's now interacting with the crypto industry, or a heavy-handed approach, which is kind of the European approach. The U.S. is getting back to what the U.S. has done well. We're going to basically innovate. There are going to be refs out there. So there are going to be some controls, but we're going to accept that there are going to be setbacks and failures along the way, but they should be ones that don't kill us, right? They should be ones that we learn from. And that's the United States. And so this administration coming in, and look, I wasn't a fan of, I didn't vote that way, but I'll call a spade a spade. I'll give them credit where credit is due. They are making the right noises that they're going to basically still have a strong regulatory environment that looks out for fraud, but they're not going to basically be afraid of innovation.
So one of the things that makes the U.S. unique in particular is this sort of division where you have regulation and oversight at both the state and federal level, right? And on the one hand, that can be good for innovation, right? Like in places maybe New York and Wyoming. But on the other hand, it also means you have to get 50 different licenses across 50 different states. Do you think for this new era of money, we're going to require something like a federal charter or something?
Well, I think we've seen in some of the stablecoin legislation coming up, they allow there to be state regulation up to a certain threshold. I've heard $10 billion worth of a stablecoin, and then it switches to federal. I personally think that there should be an ability to choose between whether you're going to have state regulation or federal regulation. We have a two-tier system. We've always allowed an option to be chartered, like for a bank, at the state level or at the national level. I also do believe that should happen for money transmitter licenses. I believe there should be a national money transmission license, the equivalent of what Europe has with an EMI. Politically, that's been really tough to get to. But I also think that folks that currently are suffering through getting 50 money transmitter licenses ought to have an ability to get a banking license instead, which lets you basically do a lot of that activity on all 50 states on a preemptive basis. We used to, in this country, have 50 to 100 new banks a year. That has dwindled down to a trickle of a couple a year because it's become so onerous to get a bank license. If you do have one of those, though, you could preempt a lot of the money transmitter licenses by just trading under a banking license. And that's one of the things we've done. We own companies that have those money transmitter licenses. We also own a bank. And I can tell you, if we're introducing a product that's like a tokenized deposit, I'd much rather do that with one banking license than have to go out and get 50 money transmission licenses. I will say something about the federal versus the state level is it's one thing to have a two-tier banking system. It's another thing to have 4 or 5 regulators all overlapping. So even at the federal level, we have the FDIC, we have the OCC and the Fed all as federal regulators. And then we have the state banking regulators as well. And so I think 4 regulators is overkill. I'd like to see a 2-tier system where there's a national regulator and a state regulator, and those other entities, and I'll be very specific here, I don't think the Fed or the FDIC need to be bank regulators. The FDIC could be an insurer and rely on the regulatory exams of either the OCC or the state regulator, as opposed to having their own examination team. And the same thing's for the Federal Reserve. Federal Reserve's got a lot to do. It does monetary policy. It runs the payment system. Does it really need a duplicate regulatory exam review team that's going to basically many of the same banks that the OCC is going to? And I go back to that saying, just having more men around doesn't mean you can have a baby in less than 9 months. Just having 2 regulators looking at the same thing, I don't think actually adds safety and soundness. It just lets sometimes the parties that are being regulated play one regulator off against another, switch between regulators. This duplication of regulation has not proved to serve this country well. I do think the dual system does work. It does mean that states can charter banks that might do innovations that the national regulator wouldn't do. And so we do get a little bit of innovation that comes because, you can do one thing in Wyoming that you can't do in, say, Georgia, right? And that's a system that does acknowledge that for some things you want to basically do them on a small scale, and you start small versus going big and going for a national charter. That I support, but whether you can do that with 2 regulators versus 4, I think 2 is enough.
Yeah, and I mean, given that regulatory structures, at least in my lifetime, don't really change all that much, I think the fact that we're even having this conversation speaks to the opportunity of this next chapter. You have any final thoughts?
Well, I would just say Elon's already gone after it. He's asked the question about, do we really need to have FDIC regulators? He's not suggesting getting rid of FDIC insurance, but the insurance program could just be run by like Treasury. But do you really need an army of FDIC, box checkers running around? I do want regulatory exams. I want them to be hard exams, but they should be by a group of examiners that actually know enough about what they're doing that they can actually ask real questions. So I think Elon's onto something here. And look, after the financial crisis, we got rid of the OTS. It was another regulator just for thrift companies. And they were not up to the task of reviewing a company like Countrywide, which was a huge thrift. And, it was right there in front of their eyes. And that does not serve our country. It does not serve consumers well.
The process-based system, right? There are good intentions there, but at the end of the day, we do need to look at the core problems.
Look, we have a saying, you can be doing things right or you can do the right things. And there's nothing wrong with doing things right. But if you're so busy doing things right that you don't do the right things, you're going to get a Silicon Valley Bank. You're going to get a Countrywide where the boxes were checked and the Titanic went down. So I really want us to get to a world in which we're not doing risk and compliance theater. And I'm greatly relieved that last 4-year period is coming to an end.
I think a lot of people are, Greg. Thank you. And we'll see you on the next one.